Hello and welcome back, guys. So, in this particular series, what I'll be discussing is about interview related questions, right? And firstly, I will be getting all this information from different sources, okay, and I'll be providing proper attribution to them. So, that's my intention of it. So, it's not for commercial purpose or anything. Right, and this one I picked it up from LinkedIn. I'm not sure about the author name, but it's not my content to be sure. Huh? So it's just what I have found, and then what I've read, and then what I find it to be a little bit useful to you guys. So that's why I decided to do a video on it. Okay, so to whoever is the author, of course, I will whichever content I normally use, I tend to take the permission and then do it from there. Okay. So this is more about 50 financial modeling related questions, right? Interview questions and answers. So let's just check the 50 questions that there are. So first question is about what is financial modeling and why is it important, right? So what is financial modeling? So financial modeling is basically a process of creating of a representation of companies. Okay, so next thing is basically why is it important, right? So we it's basically a representation of financial performance, right? So it's basically just providing you how the company is performing and how it will perform in the future. It could be it's basically essential in terms of decision making, and decision making for it could be either valuation or it could be forecasting, right? So it could be either, it could be either valuation or for forecasting reason as well. That's why we use financial modeling. So what is basically the components of financial model is so whenever we talk about any component of financial model, we need to talk about basically all the financial statements. So it will be income statements, balance sheet, cash flow statement, assumptions, right? And supporting schedules. Okay, so assumptions are very important in terms of financial model, and because they are what makes it what kind of growth values you are using, right? So whatever assumptions we are making, it's there is not a single correct or wrong answers in terms of uh, your forecasting or anything. It just depends on your assumptions, right? So if the industry is projected to grow, or if it grows with the economy in the past, then they can use that as an assumption, right? So it just depends what kind of assumptions we are using. And of course we will need to use supporting schedules and stuff, right? So yeah, it just depends. Okay, but assumptions are the very important thing. Based on that only we can judge whether a financial model is good or not. So how do you build a three statement financial model, right? So we first of all need to start with income statement, then we need to move to balance sheet, and then after that uh, so after we do that, we basically create cash flow statement, right? And of course it will be interconnected, right? So that's mostly we start from your trial, do some adjusting entries, right? And then we do closing entries, then prepare income statement, right? And prepare like schedules and stuff, right? And then we move to balance sheet, update the schedule and stuff, and then we create cash flow statement, statement of changes in equity, right? So since this question only talks about three statement, but there are other steps involved as well. Next thing is how do we differentiate between a financial model and a budget, right? So financial model is basically forward looking, right? It's useful for decision making and valuation purpose, while budget is most of is about a plan to manage and control expenses, right? There could be a revenue related budget as well, right? Revenue budgeting is there as well, but in most scenario it's more about managing and controlling expenses. Okay, so that's the difference between them. So what is the best practices for creating assumptions in a financial model, right? So assumptions, what is that? This is the most important thing. It has to be realistic, it has to be detailed, it has to be well documented, and it needs to use historical data either, or it should use industry benchmarks and expert opinions. Okay, so it could be combinations of these three as well, but what should it be? It should be well documented. Whenever we are providing any financial model, we need to state or be very clear in our report. Normally it's done in a reporting format, right? So in that, our assumption should be very clear. Next thing is we do sensitivity analysis. And why is it important, right? So sensitivity analysis is nothing more but uh, it's a analysis of risks basically, right? So uh, it basically highlights how uh, the model output, or let's say the profitability. Let's say we are looking at a sensitivity analysis of a profit, and how, like, in best scenario what happens, and in other scenario what happens. But this is more about assumptions changes. Okay, so if the growth rate was assumed to be 5%, right? So what happens if it becomes 3%, right? So if the assumptions change, based on that, key assumptions impact, and not only just assumptions but the important assumptions, if they change, what happens to the model's output. So model's output could be in this particular scenario, it could be a profit, right? So profit could be the output value, right? It just depends. Okay, and why is it important, right? So it's basically important for risk assessment, right? So basically, how much premium we need to charge, right, to provide investment for this particular company in terms of valuation, or in terms of forecasting, what's the risk, whether we want to lend to this particular company or not, right? It just depends. Okay, so and next thing is, it's basically important for decision making, right? So decision making for investment, or for loan, or any other thing, just for the outlook of the company, right? Next thing is, so what is the difference between DCF and CCA, right? So DCF is basically it's more about discounting the future cash flows, right? Future cash flows, we just bring it into present values. So 5 years down the line, what are the revenue that are coming in, and then we discount every year's revenue by a certain number, right? So discounting at a certain number, and then getting the present value of it, that's DCF, right? And in terms of comparable analysis, it's basically just comparing the multiples, right? So it could be the multiples of with similar companies in the same industry, right? So how it does in terms of uh, same companies in the industry, right? So whether it's beyond, like, above the benchmark, or it is below average, right? So we can just get the value of it. Okay, so in terms of multiples. Okay, so we can be comparing it at multiples, it could be any other things, it can be. But whenever we are doing a valuation kind of thing, in terms of CCA, it's mostly uh, it's normally about um, it's mostly about the industry performance, and what's the multiple of the PE ratio, or any other ratios. Okay, in terms of profitability and other things. So what is the formula of calculating WACC? So WACC is nothing but it's a weighted average cost of capital, right? So when does WACC comes in? So if there is a debt, then only we need to basically calculate WACC, right? So WACC is nothing but it just gives us the cost of capital, and it's a weighted average cost of capital for the debt component and then equity component. Okay, so what we do is, right, so what we do is we do equity, right? Equity divided by equity plus debt, right? So that's what makes capital, right? But we want to, so let's say shareholders is investing at 8%, and somebody else is investing at 10%, right? So the bankers, right? So they could be providing at 10%. So in that situation, what happens? What's the cost of capital, right? So first of all, this has to be, suppose the company has a equity ratio of 20%, right? And this, I mean, 80%, right? So 80% times, 8% plus your 20% times 10%, that's your, then we get a tax credit on this one minus, let's say, 25%. So that's your WACC basically. Okay, so that's the formula. So uh, what happens is, what's your total capital? Total capital is basically nothing but the V over here is value. The total value is basically uh, your total equity plus total debt, right? So V over here, let's say if it is what I have said is 80, right? So 80, so let's say the number of shares in a company is 100 and 80 is equity backed, 20 is debt, right? So the value will be 100, so equity will be 80 divided by 100, 100 times whatever the rate is. So 8%, let's suppose, plus, right, plus what's the debt? Debt value is 20 by 100, so that will be 20%, right? Of course. And what's the percentage on this? 10%. And then times 1 minus what's the tax rate? So let's suppose it's 25%. So if you calculate this, you will get your WACC. Okay. So if there is no debt, of course, it will just be the WACC will be basically 8% only. Suppose if there was no debt, and so that means it will be and just this percent, right? Because there will be no zero. So zero divided by something will be zero, right? Of course. So WACC will be just your cost of equity only. Okay, so what's the tax rate normally? It's basically the corporate tax rate. Okay, so RD is cost of debt, right? So it's just basically calculating, how much of capital, uh, or how what's the cost of our capital if we have on the basis of proportion of the capital with their rates. Okay, that's what we are doing over here, right? With the formula, basically we are getting, the equity portion, how much is it, right? Multiplying that with the rate of its capital, right? So that's giving us, how much proportion of that 8% we need to get, right? So and then it just depends, like and then for debt as well, it's similar thing, right? It just depends what's the proportion will change our cost of capital, right? Proportion will be important because it could be pulling towards, the cost of it. If the equity proportion is higher, it will be, the cost of capital will be similar to cost of equity, right? So if the proportion of debt is higher, what happens is our WACC could move in similar to, or the number closer to uh, debt basically. Okay. Next thing is, how do we calculate the terminal value? So terminal value is often calculated using perpetuity growth model, or the exit growth model, or you can say it's a Gordon growth model, right? So in that, what happens is, we assume that the company will function for a long period of time, right? So normally what we tend to do is, we tend to discount it by the rate only. Okay, normally that's what we tend to use for to get the terminal value. Okay, uh, that's how we basically get the terminal value. You could just search for perpetuity growth method formula, you'll see that as well. But normally this is what we normally use. So it's just, whenever we are discounting something, we do 100 divided by 1 plus r to the power n, right? So normally in this situation, what happens, n is not there, right? So we normally tend to do 1 by r. Okay, so since this is 0 point something, right? So this will, r will be, let's say, 10%. So that's like what, this will be 10,000, 10,000, I guess, or 1,000, right? So that's the value of it in perpetuity, right? Over his lifetime, we'll just get 1,000, right? But if you normally see it, the perpetuity formula, we just assume it, like we don't know how much it will run, right? The company might run for 100 years to 200 years, but that's how we use it. Okay, And next thing is what's the concept of working capital, right? So working capital is nothing but the short-term obligations, right? So it's more about short-term liquidity of company, right? So whenever we want to purchase something and then we want to pay the current liabilities and stuff, right? So it's more about just the current obligations side of things. So how is it calculated? It's basically current assets minus current liabilities. Okay, so it's everything that we do in a year window, right? That is basically how much can we service our liabilities in a particular year is basically your working capital. Okay, so the formula is, of course, current assets minus current liabilities. This always has to be a positive number, otherwise you are in trouble, right? So what is EBITDA? Right. So why it is used in financial analysis? So EBITDA is nothing else, but if you see, it's basically earnings before interest, taxes, depreciation, and amortization. Right. So it is used to assess a company's performance without the influence of capital structure or taxes or non-cash expense. Okay. So it's basically giving us true cash related expenses. That's true without taxes, because that is tax is basically dependent on profit itself, right? And without the capital structure. Okay, so how much is the business actually making if there were the not the influence of all this capital related paybacks or anything in terms of taxes or in terms of non-cash expense. So what's the true earning potential? Basically, that's what it basically gives out. So it's sort of like how much operating money can you be making, sort of thing. Okay, of course there is cash flow to back it up, but yeah. So how do we handle seasonality in financial model? So basically seasonality is normally incorporated by adjusting the assumptions, right? So we can be using different averages, right? There could be separate schedules to account for this seasonal variations, and then there'll be a bulk figure in terms of revenue, but there will be schedules which will be explaining, right, how the seasonality was used to calculate that revenue. Okay, so mostly it's about adjusting the assumptions. So, what are the key drivers of revenue forecast, right? So, in a financial model, so normally what happens is, of course, in terms of revenue, it's always the pricing, it's always the volume, it's always the market share. And normally people tend to do this, right? So, in terms of simple valuation, you tend to do pricing, volume, and then, market share. Mm, my market share as well, people can assume, but in terms of microeconomic factors, this is where you need expert knowledge. Okay, because you need to be able to predict a little bit of macroeconomic factors and stuff, right? So you might be using figures from IMF or any other places, right? So yeah, all these are the drivers basically which will affect uh, our revenue, right? So the next question is, how do we calculate depreciation and amortization expenses? So it's basically very simple, right? So we basically use any straight line or accelerated methods for in terms of real assets or in terms of physical assets, right? So depreciation is always there, and in terms of amortization, it's basically used for intangible assets, right? So uh, intangible assets like your trademarks, patent, right? So all these things we normally tend to use intangible assets. Okay, so something which can't be touched, right? So which does not exist in physical form, we normally amortize them. Okay. That's how we do the depreciation side of things. Of course, there are multiple methods, but like normally straight line or accelerated methods are the common ones. So, what is the purpose of sensitivity table in financial modeling? It's very important. It's basically gives out like how one assumption changes affects multiple output variables, right? So how let's say how the costing of a particular project can affect the profitability side of things. That's like one assumptions that can change the output or the profitability of the whole company, right? So in different scenarios, it basically is useful for risk assessment. Okay, so it's very important when it gives us the idea of risks, what's the risks involved. That's how we should be answering it. Next is net present value. So there is a word over here. Net is always something that has been deducted from. So net is nothing but let's talk about present value first of all. So present value is let's say you have a cash of $100 that you will be receiving in next 1 year. You have a thing. So there is a formula 1 plus r to the power n. So if you plug in, like, let's say 10% is your required cost of capital, let's say. So 100 divided by 1 plus 0.1 to the power 1, right? So 1 year. So 90 point something is your present value, right? Present value. Right. So let's say if you had invested 85 today and you will be receiving 100 later on. So what's your cost of what's your NPV over here now? 5.90, let's say. All right. So this is NPV. Okay, that's your NPV. So NPV is nothing but it's a sum of all the present values of cash. So there could be 90 and then there could be anything else as well, right? So all those things minus your initial investment. Okay, so net present value is always the sum of present values, right? So so it's just the sum of present values of cash flows minus your initial investment. Okay, so if it is normally greater than zero, it's a positive project, right? So we normally tend to invest it in it. Okay, but let's say if you are not getting um, the value greater than your cost of capital, then we normally tend to not consider it. Okay, but NPV greater than zero is always a good thing. That's what we are looking for. Okay, but that just depends on how you have calculated a lot of things, how the present value of cash flows was calculated, what was the assumptions it affects, that also affects it as well. So what is the difference between enterprise value and equity value? So enterprise value is basically equity and debt. Okay, and equity value is basically just the value of the shareholders only. That's pretty simple, right? So how do we calculate beta? So beta is nothing but it just measures the company's sensitivity to market movements. Okay, so we calculate it using a regression analysis against a market index. Okay, so it just provides us the sensitivity of uh, to the market. Okay, so normally market beta is considered to be 1, and then like we calculate the companies to it, and then we just calculate how much of a sensitivity does the company have in terms of the market, right? Next question is about the concept of waterfall model, right, in private equity. So waterfall model is basically distribution of profits. Okay, so in terms of private equity investments, typically in hierarchical manner. So it's waterfall model in terms of private equity is nothing but how the money trickles down in terms of private equity for different stakeholders. Okay. So next is how do we interpret inflation? Okay. So normally what happens is we can adjust the assumptions, right? So assumptions, cash flows, discount rates, right? So for inflation, we create a model in constant dollars or nominal dollars, right? So it just depends on uh, what kind of model that we want to create. Okay, so we can basically adjust for inflation as well. All right. Next question is about DuPont analysis. So DuPont analysis is basically it decomposes a company's return based on ROE into its different components. Okay, so so mostly it's about net profit margin, and then asset turnover, and then financial leverage. So it's a combination of all these three things, and there is a formula for this where we use to calculate DuPont analysis, and then uh, based on that, it's mostly how better a company is performing in terms of the profit margin, the asset turnover, and the financial leverage. So it's mostly a holistic look of that company from a financial health perspective. Okay. Next is question number two. What are different kind of valuations methodologies that there are? So of course there is market approach, there is income approach, there is asset based approach, right? So a market approach is basically it uses comparables, right? So mostly comparing it with other companies in that same industry. Income approach is basically discounted cash flow basis. We get the value from discounted cash flow, right? So market approach is basically using the market value to based on the PE multiples, comparing it with the industry, and then getting the value for our company, right? And other is asset based approach. So this is not so commonly used, but yeah, it you basically values the assets and then liabilities directly, right? So basically your shareholders equity is basically your asset value over there, right? So it's basically assets minus your liabilities. That's your uh, value over there, but that's the minimum value that you want to get, right? Of course, normally in general scenario, it's mostly done using the market approach, because asset based value does not incorporate intangible assets such as goodwill and stuff, right? So it just depends. Okay. Next thing is, but that's the minimum that you want to get for your company basically. 23 is how do you handle issues in missing data in financial model. So we can use different techniques such as interpolation, extrapolation, and industry benchmarks to estimate the missing data, right? So these are multiple techniques to do that. So normally industry benchmarks is considered to be better rather than the judgment of a single person, right? So collective judgment is what is basically the industry benchmarks, right? So 24 is what is the difference between unlevered and levered beta, right? So unlevered beta is basically companies risks without accounting for debt, right? So we unlevered beta is basically when we don't consider the debt side of things. And levered is of course leveraged company. When you talk about it, it's the word in itself that explains, right? So levered company is it has debt. Unlevered is basically it does not have any debt, right? So whenever we are looking at the impact of debt, we tell that to be a whenever we look at the impact of debt, it's a levered beta. Okay. So we want to, what is this question asking? Explain the concept of earnings before taxes and interest and taxes, right? EBIT and its significance. It's basically a company's profit before any interest or taxes, right? So it assesses financial performance, right? It just depends how we want to use it. So in different scenarios we might want to use this, right? Next is what is the purpose of sensitivity analysis tornado chart? Okay, so it's basically just a sensitivity analysis, and it's changes to any individual assumptions. So what will be the output of it? But we normally do it in people normally do it can be done in Excel, but normally when you put it into a chart, like a tornado chart kind of thing, it basically tornado chart basically just shows this in terms of graphical form. That's it. Okay. So next is 27 is how do we calculate weighted average life of a bond, right? So weighted average life of a bond is nothing but the sum of present values of all the bond coupon, right? So 8% coupon, it could be 7% coupon, right? And then all the principal payments divided by total present value. Okay. So it's nothing but it's just a simple valuation of a bond, right? So discounted valuation of a bond kind of thing. You can just say that as well. Okay. So like if you are getting 888 at the thing, and then you got 100, and then you just discount this, and then at multiple years, and then you get the mm, present value of it, and that's your basically weighted average life of a bond. Okay, so what is Monte Carlo simulation in financial models? So it's basically assesses the impact of uncertainty by running multiple iteration. Okay, so it's like running in a loop kind of thing, so with random inputs to produce a possible range of outcomes. Okay, so it's like simulation. It's simulation in the name itself, but what happens is whenever we are running it 10,000 times or 20,000 times with different input values, what happens, what's the range that we get, right? So basically it could be it's like how 10 to 20, it could be this many times, 20 to 30, it could be 30 times. So all this you get a range, like 20 to 30, so it'll be within this bracket kind of thing. Okay, so that's what provide us that's what Monte Carlo will provide us, the list of possibilities. And next is calculate equity risk premium. Okay, so equity risk premium is expected return on stocks, right, minus your risk-free rate of return. Okay, so risk-free rate of return is whatever you get from a government bond. Okay, so government bond is basically your risk-free rate of return, right? And the difference between them, or what you normally do is, so let's say the bank is providing you 6% or something like that. It's let's consider it to be a risk-free rate of return, and 3%, right? So this is your so you want 9% return, right? So the bank is providing 6%, and then the differential between them is 3%, right? So that's your risk premium basically. So this is used to calculate what this is used to calculate the equity side of things. That's our cost of capital, cost of equity. Okay, 9%. 30 is about concept of cash sweep. Okay, so it basically what happens is, what's a cash sweep is, it's a mechanism where we allocate excess cash generated by a project to pay down debt before distributing it to equity investors. Okay, so basically we want to reduce our debt exposure first. Okay, it could be like not the whole thing, right? Whatever excess cash is there, it's not like whole thing towards debt, but some proportion of it. Just depends, okay, what kind of mechanisms we are using. So next thing is what is the difference between pro forma income statement and historical income statement? Right, so pro forma is nothing but future financial performance. Historical is of course past, right? The name itself suggests. 32 is how do we calculate the average collection period for accounts receivable, right? So average collection period is nothing but account receivable divided by your average collection or average daily credit sales, right? So that's your average collection period. Okay, So account receivable divide by your average daily credit sale. Okay. Next is what is the purpose of scenario analysis, right? So we basically have different scenarios or assumptions, right, on project's financial outcomes. So best, uh, and then optimum, and then the worst scenarios. It's just different scenario situations. That's it, right? And next is how do we calculate cost of preferred stock in a WACC calculation. So cost of preferred stock is the dividend rate, right? So the preferred dividend rate divided by the market price of preferred stock, right? So that's our cost of preferred stock. Okay. Next is what is EPS and then what's its relevance. So EPS is nothing but earnings per share, right? So it just gives it out. So net income divided by your outstanding shares. Okay. And it's key metrics for investors and analysts, right? So from a standard perspective, we normally have a different way of calculating it, a little bit different net income. And then when we are using this outstanding share, we normally tend to divide it across different months, because there might be some stocks that have given out bonus shares kind of thing, and in that situation it might be a little bit different. Yeah, right. Then there is diluted EPS as well, but what we can just remember is net income divided by your number of outstanding shares. That's your EPS. Next is what are the limitations of EBITDA, right? So EBITDA is it basically ignores, it's only about OPEX only, right? So it ignores CapEx, capital expenditure. It basically ignores working capital changes, right? Taxes, right? So it's basically it can lead to inaccurate assessment of the financial health, right? So how do we calculate sustainable growth in financial model? So sustainable growth rate is basically calculated as ROE times retention ratio. What's the retention ratio? Is the proportion of earnings retained. Okay, so how much earnings are we actually retaining? Okay, not how much are we returning your that's basically your if you're making 100, how much dividend is paid out, and how much are you retaining basically. Okay. So waterfall chart in financial modeling, right? So it's basically a visual representation of how different components contribute to value or changes. So it's sort of like a stacked diagram kind of situation. Okay. So how it just shows how different different component adds to the total value of things. Okay. So how do we incorporate debt covenants? Of course, debt covenants are contractual agreements, right? So it's like covenants are like the conditions in a agreement. Okay, so we should ensure compliance with its covenants, right, and its impact. Otherwise, there might be different. It will basically be increasing our liability side of things, of course. But when the covenants are breached, it basically is very bad sign to any kind of investors, whether it be capital investors, or it could be debt-based investors, right? Because that will basically negatively impact the company. It's like saying they don't pay their debt on time, right? Unless there is a cash flow problem, normally company tend to pay it. So what is EBITDA margin? How is it calculated? It's basically a vertical sort of ratio calculation, right? So EBITDA divided by your total revenue, or it's basically expressed as profitability as a percentage of revenue. Okay, we are moving into lease in 41. Sorry, there are two types of lease. So operating lease and financial lease, right? uh, Financial or capital lease. So what happens is over here is basically when the significant proportion of risks and control is moved into the lessee, or whoever is taking the asset as rent what happens is capital lease accounting, they normally show it as a right to use assets, right? In terms of operating lease, what happens, they basically don't need to show it as an asset. Okay, so operating lease are basically expensed over time. Okay, so it basically is, so you have 1 2 3 year, and then 10,000, 10,000, 10,000. That's all you will see. Okay, so whereas in terms of capital assets, what's happened, it's basically treated as asset acquisitions kind of thing. Okay, and it will basically be expensed out from depreciation and interest expense. Okay, so it'll be measured at present value, right? So it will be measured as at present value, and then of course what happens is, so suppose, let me just get rid of this. 100 is there. We have like this side of things over here, right? So that will decrease the value. So this is the depreciation, this is the asset, right? Significantly over here in the liability side, you'll have lease liability, and some value over here. And then we have interest expenses that affect this. Okay, so every year it's just there is a movement in both side. Next thing is, how do we assess the credit risks of a company, right? So basically it can be done by analyzing financial ratios, credit ratings, right? So there could be AAA, different credit ratings. Agencies provide different credit ratings, right? uh, then there is company's ability to meet its debt obligations, right? So that's how we measure or assess the credit risk of a company. Next is about the concept of Modigliani, I don't know how to pronounce this, Miller theorem. So it basically states, in a world without taxes and bankruptcy cost, the capital structure basically does not affect the value of firm. Okay, so it basically ignores taxes and bankruptcy cost, and how that does not affect, it's just a theorem basically. Okay, how it does not affect the value of a firm. Okay, so next is 44, is about what are the key assumptions in DCF and how do you justify them. So assumptions could be revenue growth rates, right? Operating margins, capital expenditures, discount rates, which should be based on thorough analysis and research. You need to know that particular company, industry, everything. Okay, just to compute the rate of growth is itself is very challenging, right? So how do you calculate terminal growth rate, right? So often it's basically sustainable growth rate of the company over the economy. It's normally 2 to 4% or very minimal kind of value, right? So of course we can find the sustainable growth rate and then use that, or it could be the whole economy is the best. It basically should be, it's normally is very similar to the economy growth rate. Okay, so what is the purpose of cash flow waterfall in project finance modeling? Okay, so what happens is in terms of cash flow waterfall, right? So we normally tend to represent the distribution of cash flows among various stock stakeholders, such as lenders or equity investors, in a structured manner, normally on the financing side of things. Okay. Next is how do we handle foreign exchange risks in financial modeling? Of course, there are multiple hedging contracts, hedging options there are, right? So we can use forward contracts, options, scenario analysis, right, to assess the impact of currency value fluctuations. Okay, so forward contracts is basically what it's more stable sort of things, right? There could be options. Yeah, multiple hedging instruments are there that can be used. Next is the concept of leveraged buyout. Okay, so leveraged buyout is nothing but it's when you evaluate the acquisition of company using debt or significant amount of debt. The intention behind it, it's mostly, to maximize returns for any PE investors. So leveraged buyout in itself is basically just acquiring a company, but financing it using debt. Just remember that that should basically be uh, basically covered. Okay. So 49 is how do we calculate weighted average lease term for a real estate investment, right? So weighted average remaining lease term for a property is basically it basically considers the expiration date of each lease and its proportion to income, right? So why do we normally do this is basically to assess, how much income can we expect with, future facing contracts, or like in terms of long term contracts, how much of that revenue is definitive. That's what we are trying to get. Okay, so it's just average remaining lease term, right? So that basically how much of that is contributing to the revenue. Next is what's the concept of waterfall model in terms of PE fund. So waterfall structure, it basically defines order and then distribution of profits among investors, right? And it basically shows this in terms of priority and different hurdle rates that is defined for all these different investors. Okay, so it's just showing, the Mm, the return that the company generates and how it can be distributed across all these different investors in terms of their own priority, in terms of their hurdle rates. Okay, so it just provides, how much can you expect uh, from the company perspective, and then the change in different hurdle rates for different class of investors. So it's mostly used for the fund management or asset management companies normally tend to use this to pitch it to any investors and stuff, right? So that's pretty much it, the interview questions. So it's a very good questions, right, I must say. So 50 financial modeling interview questions has been covered. If you have any questions or doubts, do comment down below. Thank you for your time. Take care. Bye bye.